Okay, so that's opinion coming in from Ed Yardini. Get it over with. Do 100 at least. Markets are kind of preparing themselves for a big one. Rajat Bhattacharya, a senior investment strategist at Standard Chartered, he's joining us right now to take some questions. Rajat, good to have you with us here. Thank you very much. The backdrop is looking a little tricky, isn't it? US markets are selling off. In India, which is what we want to primarily focus on, has been very resilient. Extremely resilient. I want to start with something which I highlighted yesterday, the fact that MSCI India trailing 12-month P multiples are at over 100% premium to emerging market MSCI EM multiples. It's the widest ever premium. How important is a metric like this, or do you think it's not so relevant anymore because the large constituent within MSCI EM, which is China, has underperformed hugely, so this gap looks artificial? Your sense?
Hi, Prashant. Morning. Yes, that's indeed true that India's multiples are high, and we maintained that for a while, that this has historically been high, right? So you need to look at not just the absolute difference, you mentioned China, but what it has been historically. So we've maintained in this forum as well that India has traditionally had high P multiples. Why is that? Because one is, of course, growth, and you got the latest India growth data as recent as this week, and you saw where growth is in India, plus 10%, right? And whereas, for instance, China, they actually had a quarter-on-quarter contraction in second quarter. Looking forward also, China will recover, but India sits right up there in growth. The second feature that we've maintained about India is that the Indian corporates managed to capture that growth better than other emerging markets. And that is why you see the corporate earnings growth stronger than other emerging markets. The return on equity is higher in India than other emerging markets. So if you take all of that and you take the history, not absolute difference, then it's justified. To your other point, what should we do about it, and whether, in terms of relative terms, whether where is the place to go? We of course think that the China, as you mentioned, the P multiples are at rock bottom, right? And China is in a place where you see the policy turning. So if you see policy everywhere else in the world, except for perhaps Japan, is tightening significantly. We'll come to Jackson Hole a bit later, but everywhere else it's tightening. China is easing. In fact, as recent as August, they cut rates. And we expect further cuts in rates. They are doing a lot more in fiscal terms. They're trying to stimulate consumption. They are actually targeting a lot of their stimulus towards their consumers to ease their burden, and then what we see is the property market. That's the big one in China. A lot has been said, but a lot has been also done over the last 1 month, let's say. They've gone ahead and eased liquidity for property developers. They're now trying to encourage people to buy the second homes, lowering mortgage rates, and all of that is basically saying that China is in a very different spectrum in the global landscape. And given where the PE is, it's beaten down, and that is where all value investors will see value. So relative terms, I would say that China looks better at this stage, and which is why China and Asia ex Japan, by and large, the Asian equity markets look to us as the place to go right now.
Rajat, hi, good morning. But the issue is that this is a market in which momentum investing perhaps works more, right? So is it possible just that in the near term, perhaps the Indian market continues to outperform?
India's done very well, so you're right there that the momentum is with India. That's the one market that stands out across the globe, actually, if you look at charts. But to your point, and this is where I bring in Jackson Hole, what you discussed a bit earlier, the key lesson from Jackson Hole is the Fed is not budging. The Fed is not stopping here. There's a long way to go. That was the message from Jerome Powell. So if markets were thinking that he's going to back off, given the recent slowdown in PMI data and the some consumer confidence, the drag down in consumer confidence. That's not what he's looking for. He's looking for job market, as you mentioned, and the inflation data. So I heard of some commentary that inflation is coming off. That is correct, and the latest one being the unit labor cost. We look at that unit labor cost. That is a broader measure of how inflation and wage pressures are in the U.S. That came off to around just about 10% from 12.5% in Q1. So it's come down to 10% year on year in Q2. But we're talking about 10%. Fed is not going to be happy with that. What Powell is saying is that the job market is too tight. It's at a 50-year low. It is way tight for them to even consider, even think about slowing here. So what that means is that probably we're going to see another 75 basis points hike in September, another maybe 50 basis points in November, and then we'll see. By then we'll get 2 or 3 more inflation prints. You're right that month on month inflation has been coming off, but they want to see several months of that. And secondly, they want to see this high job openings rate in the US, the JOLTS is near record high. They want to see the unemployment rate rise back to their 4% long-term unemployment target. Unless we get there, the job market is going to be the key problem the Fed faces. It is way too tight.
So, Rajat, I take your point. I mean, there's a big rate hike coming. No two ways about that, perhaps both in the September and the November meeting. But, the US markets have already fallen 7% since Jerome Powell's last speech. So how much of this you think is already in the price, both for global as well as emerging markets?
Yeah, that's a good point. And our parameter is probably the June low. I think Anuj mentioned before as well. Are we going to test the June low? I mean, the way the momentum in terms of the US market is going, that's the next really big stop, right? So in that sense, you have a bit more to go. But overall, I think we need to look at it conceptually. And what the message is that probably, the Fed discusses a neutral rate. It's an esoteric concept, but what it means is that is policy restrictive enough? Now, the Fed believes the neutral rate is at 2.5%, which is where the Fed is right now. But every sense that came out of Jackson Hole from all central bankers is that probably the central bankers are underestimating the neutral rate. What that means is that they may have to raise rates further, and we will see the ECB coming through, right, next week with probably a 50 to 75 basis point rate hike. And all that means is that even from 3 or 4 months ago, the central bankers now think that the neutral rate, the restrictive, at which policy turns restrictive, is a lot higher, which means we have way more to go. That is negative for stocks. Now, what that means in the short term is that you need to be very balanced in approach. I mean, that's the key the lesson we draw from these markets is that you need to be far more balanced than you were earlier. And that means that you spread out your bets across stocks and bonds. Within that, the place to go is play for regions, play for sectors. So that's why we highlight that Asia, Japan is the place to go, China is the place to go in terms of stocks. Asia dollar bonds, I mean, they were so beaten down, and India is a significant component of that, the dollar bond segment. They're yielding and that is a very high quality investment grade category, the Asia dollar bonds category, for instance. This is where you need to go, where they're paying 6-7%. That's because they were beaten down. So all of that basically goes back to the point about policies getting tighter, and you need to acknowledge that conceptually, and this is how you need to position yourself.
Okay, we will let you go on that note. Thanks a lot for joining in. So there are definitely recessionary fears, but India looks quite resilient amongst the entire lot, especially because corporate growth is picking up in the Indian markets. Let's slip into a quick break. On the other side, a list of top 10 stocks is coming up. Don't go anywhere.